Good afternoon, everyone, morning for some and evening for others all over the world. Before we get started, if you can just confirm for me that you can, looks good and sound, man, you guys are on top of things. Excellent. Appreciate that. I will get the recording started and we will get going. Again, welcome everyone to today's session. This week is a bit different because of the Thursday expiration option. So I'm going to get right into the trade that I am looking at right after the normal introduction stuff, just to make sure everybody doesn't go hog wild on this trade. So again, today is the Monday session for the expiration of Thursday's option. That's what we're going to be looking for, is the trades that end on Thursday. As of this weekend, if you have not upgraded your subscription, I would strongly suggest that you do so. Call Spring at that number and get that updated. I'll go over all of this here in a minute. If you are new to the call, if this is your first time or even maybe your second time, welcome. I do want to caution you as we get through this. I'm not going to explain everything in today's call about what we're doing. I don't explain all of the logic. I don't explain the details of everything. You will learn a lot, but that is not the purpose of this call. It's just simply for you to watch me apply the things that I teach elsewhere. And so don't expect everything to be explained on the call. And if you decide to take some of the trades or one of the trades or both trades or whatever the case is, you want to start small. The trades are absolutely fantastic, as again, you're going to see today, but you want to start small because if you make a mistake and you make a mistake on a big scale, your mistake is going to cost you a lot of money. You don't want to be reckless about how you throw these trades together, thinking that, oh, I'm just going to throw a couple of these trades together based on, a similar situation or similar pattern, and I'm going to come up with the same thing. And it doesn't work that way. You need to understand what you're doing, and you need to be very intentional about how you put these trades together. And then finally, you want to absolutely follow the instructions. If you don't follow the instructions, you will get hurt. It's only a matter of time. 4 or 5 weeks ago, I didn't follow my own instructions and I got hurt. So it applies across the board. I do not get an exemption, even though I understand this stuff more than anybody on the call. So one of the reasons why I say you want to go small is because you have the ability to compound. And I'm going to get to the compounding in a few minutes. The first thing I want to do is I want to bring on the trade that we have working. All right, so let me switch the screen. I know I'm rushing to get to that, but that's because I want there to be plenty of time for everybody to understand what is going on with this current trade, because the trades that we took on Thursday are so far out of the money that that the market will have to make a pretty significant move to the upside for us to realize any substantial profit potential on the trade, which it could absolutely happen. Otherwise, it's just going to be a small profit. If the market stays right here where it's at, it's just going to be a small profit on Thursday if we don't add anything to it or whatnot. So let me switch the screen share, and I'm just going to go to screen 5. And then bring this over. All right, so here is one that I've actually already taken. Actually, no, that's not true. I took one slightly different than this. Well, I'll get to that here in a second. All right, so here are the two trades, and this is very, very similar to what we've been doing, because during this transitional period, we're going to see these types of patterns available often, especially when it's looking for the reports every Thursday. Now those unemployment reports that come out have all of a sudden created this extraordinary suspense in what those numbers are going to bring, especially after 3 or 4 weeks ago when the numbers came out and they were astronomically better than what they expected, and the market just skyrocketed. That's the day I got hurt, by the way, because I didn't follow my own instructions. But nonetheless, here it is, a bearish and a bullish, a bearish and a bullish. Okay, so the bearish is the 305, 309, and that's actually a bearish neutral because the market's trading at 303.33, and it's coming down on us as we speak. That's why I wanted to hurry up and get in. I really wanted to get this at a higher price. We could still do this, but let's just go ahead and go through this real quick. All right, so 305, 309, credit of 1. I actually got into this at a credit of 110 right before the call. So 305, 309, credit of 1. That means there's a risk of $300 if the market skyrockets, and this is the only one that I take. That $300 risk would not happen until well above 309, probably looking at around 315, 316 before that actually begins to approach $300. So this obviously is the bearish neutral because the 305 is above where the market is. The market, this break even, the absolute minimum break even is 306, and we're at 303.38, right? Because of the credit. It's going to be much further than 306 because there's still going to be value on this 309 because it's a 7/6 expiration. Okay, so bearish neutral trade. Here's the bullish trade, and it's a 1-2 lot. Okay, a short 311, 7-2, and long 2, 7/6. Expiration 314 calls. Total debit here is trading at 43 cents. All right, so I'm gonna my goal is to get at least a 10-cent credit with this thing, and so I would say execute order 1. Now I'm going to tell you right now that I'm willing to execute order 1 first because I am already super bullish. I have massive bullish position on. And so many of you that took Thursday's trades, we have bullish positions on, right? So we have room for the market to move up. If this is your first trade, I would not put on trade 1 first. I would put on trade 2 first, and I'll go over that here in a second. But we'll go trade 1 on this particular one. And what happened here? Oh, there it goes. And we're going to do a credit, and we're going to say $1 credit, and then we're going to execute order 2 if order number 1 is filled, right? So we clicked on if order number 1 is filled, we're going to execute order 2, and let's see, order 2, and we're going to do that at a debit of let's see, 1. So we're going to do that at a debit of 45 just to make sure we get filled, or at least give ourselves a very high probability of getting filled, and I'm going to do 2 of those. All right, so let me put this in the right account, and we'll save it, and I'll bring up the graph here in a minute. Okay, so now we'll turn it on. All right, so I've already turned this on several times. So we're trading right at 1. It's going to be close on whether it gets filled or not. I would rather, if this is the first trade, I would rather put on 1 of my bullish and then the credit and then another bullish is how I would prefer doing it. All right. All right. So I was filled on the first trade. I don't know why it says pending, because as soon as that message comes on, it is a filled trade. So hang on 1 second. All right, there we go. So filled at 1, now trying to get in order 2 at a total of 45. Let me see where we're at with this. This also should get filled fairly quickly, actually. If it's not getting filled fairly quickly, it's a bit concerning. Yeah, the ask is at 45, so it should be filled here. All right, so that's the first one. Now what I'm going to do is I'm going to go back to smart orders, and I'm going to do a copy of that one. And I'll do the bullish first, okay? So here's the copy, the bearish neutral and the bullish. So I'm going to go execute order 2 at a debit. And it's trading it says 43. I'm going to go a debit of 46. Okay. And then I'm going to say if order number 2 is filled based on action group number 1. Okay. Then I'm going to execute order 1 at a credit. And I want to say 1. That will give me a high probability of that getting filled. And then I'm going to add a group, and I'm going to say if order number 1 is filled, right? If order number 1 is filled via action group number 2, then I'm going to execute order number 2 again. And I'm going to say at a debit of 0.46. All right, so that's a little bit. We're trading 103 and 44. So let's go one higher on that one. And there we go. Whoops. 10. Let's go 102. And then we'll go 47 on the second one as well. All right, so this one puts the one bullish followed by one bearish neutral followed by another bullish. So make sure that if I get filled on my bullish and then I don't get filled on my bearish, that I'm only risking $47 to the downside. All right, so I'm going to save that one. So I'm going to have to change that to save. And then I'm going to turn the system on. And there we go. All right, so now I've got it working in 2 different ways. One is a bullish, then the bearish, then the second bullish. And I was filled at 47. Now my credit of 102 is in place. And we'll see. It says it's trading at 103. It is the bid is actually 104. So, or excuse me, the mid is at 103. So it should be filled here pretty quickly as well. Nonetheless, let's take a look at the graph of these. All right. Now, that total credit at 102 and 47, that's actually an 8-cent credit, which is a little bit better than what you see here on the screen. Okay. This is the combination of these 2 trades, by the way. And as of right now, I actually, in reality, based on what I just got filled, I'm actually in 1 bearish and 1 bullish. All right, so I got filled at the bearish at 1 and then one of my bullish at 47. Eventually, I will have 2 bearish and 4 bullish, and this is why. Okay, so with the credit of 7, that means there's no risk to the downside. I'm going to make at least $7 if the market tanks. However, at the current market, I may not make as much as $200, but I should make, depending on how much volatility remains in those calls by Thursday, I should make at least about $100. And it's going to be somewhere in between $100 and $200. My first profit peak is at 305. And then my second profit peak is up here at 311. So that's 6 points away, and I just got filled on something else. What did I get filled on? So I just got filled on my bearish, and now my second bullish is working at 47, and looks like it was filled as well. Okay, so let me show you this here, and I'll bring it in. Hang on one second. So if you're not familiar with Trade Partner, obviously Trade Partner is my own trading platform. So here we got all three trades filled: 47, 102, and then 47. And I did a 111 on all of these. So that's two bullish that were filled, one bearish. I staggered how they were filled in order to decrease my initial risk. So first one bullish, and if that was all, if the market then tanked, I would have one bullish, and my total risk on the trade would be $47. But I put myself in a very high probability of getting filled, and so I did one bullish and one bearish, and then the bearish is 102. That gives me a total credit of 55 cents, which means if that were to happen, the market tanks, I would have a minimum gain of 55 cents. However, if the market tanked, I'd be guaranteed to get filled on this second bullish. So that was not really the worst case at this point would have been the market moves up and I only have one bullish in place, which is still a really good trade. It's just not as good as you'll see. All right, so this is, again, the trade that we were filled at as a 7-cent credit. And it's a very, very special trade because I have 4 longs, which means I have a total of 5 longs and only 3 shorts, which means if the market moves up, I can sell some more premium at some point to the upside. And I'll just mention that here now, and I'll come back to it later here in a minute. Okay, so it has 2 profit peaks. The first one is at 305, which is the first short, and the second one is at 311, which is the second short. So obviously, profit peaks come at the short strikes, always, always. There is a bit of a dead zone here, but it's really not a dead zone because the second profit peak is so much higher than the first profit peak. And so that's actually going to pull that dead zone up, and I'm not even remotely worried about that dead zone. This dead zone, however, if the market moves up to 315, what's going to happen to the volatility in these options? They're going to come out. However, there's unlimited profit potential to the upside, which means that I can sell more premium at anything at 315 or above, and that will pull this dead zone up even further. Okay, so that's the structure of this trade. Again, if the market moves down, I'm going to make at least $7. You say, oh, well, $7, that's not a lot. Hey, listen, if you average $10 a week and compound it, you're going to be doing better than the best performing stock over the last 7 years. So don't knock a small gain on some of these trades. Obviously, we're in a position to do much, much better than just $10 if the market either stays the same or moves up. And at around 311, if the market goes up to around 311, which is a very real possibility, we could make upwards of, it's not going to be $400 because volatility will drop out of these a bit, but it could be $300 easily. And that's if we exit one of the bullish trades at a significant profit, it might be even more based on what happens after that, or we can sell again another call at some point. And I'll go through that process. Okay, now earlier the market's starting to come down a bit, which means that I was definitely filled on my other let me see here, fill at $1. And I'm just double checking before I say for certain that I was. Yep, I was. Okay, so let me pull that over here real quick. All right, so you can see here, I put the credit in first at $1. It's now trading at $1.04. I put my debit in here at 45. I was filled on 2 of those. So I have this at a credit of 10. And it actually looks like it's better than a credit of 10 right now, based on the bid ask at 43 and the credit of 1. So that's no one should have any problem getting filled on this at this point at a credit of 10 or better. And that's a pretty decent trade. All right. All right. So that now, obviously, when I say no risk to the downside, that's as of the close on Thursday. Obviously, we can suffer an open position loss. It'll be really small open position loss, like we're seeing right now. We're seeing about a 7 or 8 cent open position loss right now, with SPY coming down just a bit on this, which just gives us a better trade if you want to put that on. Okay, so here's what the individual legs look like. Here's the first one. Actually, this is a 303. Let me see if I have the 304 here. No, so I'll just make this a 304. And again, so I put those trades on at a price that was very, very high probability of getting filled on both of them. And so let's, all right, so here is, and this isn't the exact fill price, but it does the job. Okay, so let me refresh that. All right. Where'd that one go? That's 303 and 304. There it is. All right, so here's the bearish neutral trade that we got into. And you can see here that the projection for the break even is at around 310. It's wow, actually that is not 304 is a 308, not a 307. So let me I'll get it squared off here. All right, there we go. Now let me. So it's 4-point strike difference. And the break even, so long as at 308, the break even projection is around 307.50 to 308. It's showing the projection at 308. That's usually going to be the case. It's going to be around the long strike in most of these cases, maybe a little bit lower if volatility begins to come out. It's not going to come out a whole lot or as much as it normally would, but this is also based on holding on to the trade until the absolute end of the week. This neutral position here shows almost $200. It's not actually $242. It's not going to be $242. It's showing a 308 as being worth about $1.40, and that 308 is not going to be worth $1.40. It's probably going to be closer to $1. So we're probably looking at about a $200 profit potential right at the 304 level. And of course, we're not trading, we're trading below 304 right now. And so because of that, we actually can see the market move higher, and we should be looking pretty good. With the bullish leg, let me find the bullish leg. I think it was actually above here. Here it is. This is 311, 314, a debit of 47. So that's where we're in at on one of them. We're in a debit of 45 on another. And this shows at 305, it shows about a break even. Okay, probably going to lose a little bit of money by that time. Not a lot, but probably $10, $20. So if the market goes nowhere, we stand to make a substantial amount of money on this trade. If the market goes up, right, if the market goes up on a single bullish trade, not double, a single bullish trade, it's projecting a profit potential of 250. Probably not going to be 250. And the reason is because the 314, in order for that to be a profit of 250, the 314s are going to need to be worth about $1.25 a piece. And they're probably going to be closer to $1 a piece. They're going to be 3 points out of the money, and there's going to be 4 days left because of the long weekend. Probably going to only be about $1, and the market will have moved up, meaning that the volatility will come out. And so if that's the case, then we're probably looking at about $200 on a single bullish trade in profits at the 311 mark. All right, now if we only had one at 311, this trade is projected to lose $124, and it's probably going to be closer to $150, $160, maybe even $170 if you hold on until the very last second. So even with one, if the market moves up, one bullish, if the market moves up, we should be making a little bit of money. Whoops, this is a 303. Sorry, let me move down. Here's the 304. At 311, I told you the wrong number. At 311, it's $123. Again, probably closer to $150, $170, maybe $75 if you hold on to the very last minute. So we're looking at least about a $25 profit, most likely at the 311 if we only had one bullish. But because we have two bullish, we can add another $200 onto that, which means at 311, we're looking at about $225 with no risk to the downside. The only risk to the upside technically is this dead zone right here. There is no risk with this dead zone. It's this dead zone where there might be a little bit of risk. And that's at 315. And if the market moves up to 315, guess what? I'm going to start selling. If the market moves up to 311, I'm probably going to start selling a 316 or 317 call and pull this dead zone up. And maybe, actually, there wouldn't be any risks, but we're going to do it on this just so you can see how it works. And I'm going to increase this to 322 to increase the perspective. And you can see that we have unlimited profit potential if the market absolutely skyrockets. And if you're in this trade and you're in the next, the one that we took on Friday, or a couple of them that we took on Thursday, not Friday, it's tremendous opportunity if the market skyrockets from here. All right, so dead zone here, we have 5 longs. The dead zone is at about 250, so that's right about the max that I want to give in this particular situation. But again, we were able to create this dead zone with 2 extra longs. And so if I can bring in any money at 315, which means if I sell a 315 for $1, excuse me, I'm going to bring this whole dead zone up by $100. If I sell 2 315s for $1 each, I'm going to bring the whole dead zone up by $200. Right? So if that becomes available, I can do that. Or I can go even further up and I can sell a 317. Now, I didn't sell a further up. I usually do a 1-2-1, right? 1 short, 2 longs, 1 short. And I didn't sell another short because they're not worth very much. But I'm going to go ahead and do that. Which number is this here? This is number 8. So I'm going to put this on 3-8. Excuse me, on graph 8. So if I were to sell a 317 right now, I'd bring in another 12 cents. And I would then I would still have a little bit of a dead zone here at 315. So it didn't really help me a whole lot. But if the market moves up and I'm able to get, let's say on a move up, I'm able to get $1 for that 317. If that happens, I still have, by the way, an extra long. All right, I still have an extra long. which means I could potentially sell 2 if I wanted to. And if the market moves up and I sell another 317 for $1, then look at this graph. It's the whole thing is basically above 300. It's not guaranteed, but I don't have a dead zone really at 315 to speak of at that point, because I created another profit peak that's fairly close, and I have unlimited profit potential to the upside. If I were to do 2 of these, because I have 2 extra longs, which I'm always in favor of doing. I'm either in favor of getting rid of one of the longs at a significant profit, or both longs at a significant profit, or selling 2 of the 217s. All right, 317, excuse me. So if the market moves up, now I've created a scenario where the whole thing is above 400, but because I am now even Steven on my longs and shorts, if the market were to continue moving up all the way to 322-ish, I actually have a little bit of risk. How much risk do I have total if everything skyrockets? And by the way, Thursday's unemployment report, market might skyrocket. You never know. Or it could tank. But at that point, I'm risking about $115-ish at 325, maybe $125 at that point. Okay, but I don't have to do that. And if I have bullish trades on from Thursday, then I can do that. I can try and bring in as much premium as I can on any surge in the market, and that will enhance the overall trade. Okay, so that is the basic trade that was available. I want to show you a couple of different things. You'll notice on this one that I have listed another bullish trade. Okay, now the market's moving down, and you can still almost get a buck credit for this bearish neutral. And why is that? Why market's down 50 cents, 60 cents? Why can I still get $1 credit for this? Because as the market moves down, the value is maintained in these longs. That's why, or in the calls, the value is maintained. If the market moves up by a point, you're not going to be able to get the 306, 310, for example, for $1 credit. It's probably going to be slightly less than $1 credit, because that's just how it works. All right, so on this one, you'll notice I have another bullish trade, and this is a 313 short and a 315 short, again 7276, and long 2 313 shorts. And right now it's trading for a debit of 76. Okay, that means that to the upside, if you do the strike difference, it's actually a -2 strike difference, and you subtract the debit, and you actually have $125 minimum gain to the upside. So this is a bullish trade. So why do 2 of these versus 1 of these? 2 of the 311, 314s versus 1 of the 313, 313, 315. A couple of reasons. This is one that we were using last, maybe a couple of weeks ago. And what happens is, as the market moves up, this actually gets cheaper. And as the market moves up, this actually gets to be a little bit more expensive. And this is a general rule. It's not absolute. And so you'll want to know, at what point do you want to switch? So let's take a look at the 2 different graphs, and I'll show you why I do 2 of one as opposed to 1 of the other. So here is the bullish, the 2-to-1, 311, 314. This is again at a debit of 47. It's trading right now at a debit of 41, maybe 42. But you'll notice that if the market goes up to 311, we have a profit potential on 1 at about 255. Okay. From that point on, if I don't do anything else, I can at least sell another call option at some point to the upside. And I could sell, at that point, I could sell a 314 for $1. I could sell, who knows, anything above the long, at or above the long, I could sell and create a pretty a decent profit potential. It just depends on where it is compared to the long, on whether it creates risk to the upside. But I'll get to that here in a second. So at 311, we're looking at $250 of profit potential. Again, that's not going to be that high because the volatility is going to come out of these a little bit if the market does move up to 311. But then we have unlimited profit potential to the upside. My risk, if this is the only trade I took, my risk is $45, $47. And right now it's trading at $41, $42 if you're to place on that trade, okay? Here's the other bullish trade. And this is trading at a debit of 84, which it was trading at a debit of 84 before the call. It's now trading at a debit of 76 because the market's come down a bit. All right, let's change the perspective on this one just a bit because you want to see basically the two trades from the same perspective, which is 295 and 318 on the first one, and so I did 295 and 320 on the second one. Okay. All right, so this one we have the market. The risk on this trade is $85. Okay, or it's the debit, $84 if the market moves down. If the market begins to move up and it moves up to say 311, my profit projection here is $318. Again, it's not going to be quite $318 because the volatility is going to come down a bit, but you'll also notice that it's not at its profit peak. The profit peak is actually where the dead zone in the first trade is. The profit peak at 315 here is at $521. That's the profit potential of this particular trade. And so what's my max risk on the bearish trade? It's $300, right? So at 315, even if at 315 my bearish trade is losing $300, this one is making $521. It's not going to be that much because the volatility will come down, but nonetheless, it will be making money. It'll be making a decent amount of money. But at 311, we're looking at about 318 compared to 250. All right. Here's the difference. With my bullish, I'm not in one. I'm not in two. I'm in one. So I have half the risk. But if I go into two at 311, what's my profit potential? 500. Not 318. It's 500. And if it goes to 311, I should be able to exit at a profit. If it goes to 311, that means my short is at the money and I have two longs that are only 3 points away and I should be at a profit. So let me show you something here, and we'll just use the same graph here. All right, here's order 3, which is now trading at a debit of 78 cents. Okay. Here's order 2. This is my bullish. It's now trading at a debit of only about 41, 42 cents. The ask is 42, so that's probably closer to where it's at. I'm just going to duplicate that one, and I'm going to what are we trading at? We're trading at 303. So let's put this at 304. At 304 and 307. So what if the market goes up to 311 tomorrow? Well, this is what it's going to look like. It's not going to be exactly this because volatility will come out on the way up, but it's going to be similar. So the 304, which is not quite at the money, is trading for a profit of, well, if we get in at 42, 165, so 120. Okay, that's if the market moves up to 311 tomorrow. We can expect our bullish trade that's trading at 40 right now to be at around 160. Okay, that'll give us $120 per each. That'll give us $240 in total profits, open position profits, if the market skyrockets and goes to 311 by tomorrow. If it does it Wednesday, it'll be even bigger profit. And if it does it on Thursday, it'll be an even bigger profit. All right. So the less time, the bigger the profit there is on this trade if it moves to be somewhere around at the money. Okay. Let's do the same thing with this bullish trade, with this single bullish trade. And so this would be 2 points out of the money instead of 311, right? So to make it the same exact ratio, we will go with a 306. All right, which is 2 points above what we were just looking at. Whoops. So a 306 and a 306. Did I pass it? Yep, I passed it. And then a 308. Okay, that is equivalent to what we have. If the market moves up, if we were to have this bullish trade on, the 76-cent debit bullish trade on, and the market moves up tomorrow to 311, making this 2 points out of the money, this is what it would be worth, about $2.15, which is about $125, $130. Okay. So that's why I chose to do 2 of these, which you can get for almost the same price. And look, so right now you can get it for basically the same price. You can get 2 of the 311, 314s for about the same price as you can get 1 of the 313, 315. That's why I did that. You could still do 1 of these and 1 of the bearish and have a credit of 20 cents. And you'd be looking just fine. So we'll take a look. We'll combine those, and you can see what the difference is. All right. So here's the 2 bullish. All right. Let's drop that back a bit, so it gives us a little bit better perspective. Here's the 2 bullish with the bearish, and what I'm going to do is I'm going to add a bearish to this here, this particular bullish. So I'm going to go 304, actually 305, 309, right? 305, 309. And there we go. Let me save that. All right. So I'm going to move this one down to the single bullish, which is SPY 3. This is the single bullish. So I'm going to go move to graph 3, move to graph 3. Whoops, I accidentally moved it to 4. So we'll go down to 4, move it back up to graph 3. There we go. All right. Now, total credit on this particular trade is 17 cents. It has a significant profit potential to the upside, no risk to the downside, but there is a little bit of risk if the market were to continue moving up with that single bullish trade. And that risk is about $150 at 325. Okay. So there's another, if you'll recall, the max or the minimum profit potential on that bullish is only $125. So let's separate these two. And so I am better off. I'm better off with my 2 bullish, leaving 2 extra longs than I am with this particular trade. And here's how that works. Okay, eventually the bearish is going to lose $300, and the bullish, the minimum gain to the upside is only 125. So I would need to exit this at something greater than $125 profit in order to boost that this particular risk up a bit. All right, so the risk on that one is actually pretty substantial if that's the one you do, but that's why I'm not doing that particular trade. If I were able to do 2 of these bullish, which we were in the past, then I'd have a similar situation, but I'm not able to do 2 of those bullish. Okay. All right. So trades on the trades that we took on Thursday. Let me find those real quick and I will address those. Hang on one second. All right. So that is not it. Here we go. Oh, nope, that's not it either. I know this is going to shock y'all, but I have approximately 20 something windows of trade partner open. So yeah, it gets a little nuts. So TPO signal on 6. Where's that TPO signal? Let me see if I can find it. Why? Uh, 629, 619. Wow, I cannot find. Oh, the $3 risk trade. That's right. $3 risk. I labeled it as March 25th. Not that was dumb. So let me pull that one up here. All right, so this is what we got into on Thursday, I apologize, Thursday. And some variation, some form and variation of this, a 2-to-1 bullish 62 cents was the bullish, the bearish is 124. These strikes are way up there. So if you'll notice here, on this particular trade, where we're at is that the 311, 316 is still worth 30 cents. And what does that mean? It means that we still have 30 cents of profit potential on this one. Meanwhile, the bullish trades, the 2 bullish trades are worth about 17 cents, which means that total they're worth about 34 cents total. So we have 34 additional dollars that we can lose on that one and make $30 on the bearish. And so we're basically sitting where we would be sitting. Again, this was at no credit, right? So at no credit, that means we don't make any money if the market moves down. We simply break even. If you're able to put this trade on at a credit, then whatever the credit is what you would be able to make money on. And I actually put some of this trade on Wednesday. And Wednesday I did it for a $3 debit. And so technically I'd be risking $3 if the markets continue to move down a little bit more from here. So what am I expecting on this particular trade? Well, this particular trade has a profit peak at 311 and then again at 317. And the dead zone is actually not until around 320-ish. Market's not going to go to 320. I'm not going to say I'm going to eat my hat if the market goes to 320, but it's most likely not going to go to 320. We're trading, market's moving down as we speak. Nonetheless, the 324 here, you can go ahead and exit that if you wanted to, and there would be no dead zone at that point. You would have the ability to replace that 324 and bring in more premium if the market actually moved up, which would create an even better trade. The dead zone was very, very small in the first place. Not even was not worried about it at all. Okay, but at this point, we are just basically sitting on this trade, which is why I said there's no problem adding a trade to that trade with today's with today's market fills. There are some who have asked, okay, well, what do we do? How can we create something that's a little bit more neutral? Well, the problem is that most of these are based on trying to get a zero credit, or excuse me, a zero cost or a credit. And once you start moving into the money, it starts getting harder to do that. All right, so if I move back, let's see, if I move this back in here, and actually, you know what I'm going to do? I'm going to create another one of it, is what I'm going to do, just so you can see here. And by the way, I'm not opposed to creating a debit, but I don't like losing money if the market moves down. It's just something that that I've always tried to make as a general rule. But I understand, if the market moves down, I also would like to make some money, which is why you can create some of these with a credit if you are willing to spread out that dead zone just a little bit more. So I'm going to make a copy of this. I'm going to pull it over here, and we can make changes to it. Okay, so here is, it'll come up here in a second, and looks like we have a slight problem. Well, maybe. Signals copy 2. Wow, I have no clue what happened there, so I'm going to close that and I'm going to do it again. Hang on 1 second. So I'm going to duplicate that. All right. All right, so here's a copy of a copy. What could you do to create a more neutral scenario? Well, you could go in the money with this bearish, and then bring down the bullish. But the problem is that we'll go down 3 points. Okay, so 302, 306. You're going to get a bigger credit on the bearish. 302, 306. It'll update here in a second, and then we'll pull down the bullish. So it's a $1.44 credit. So we'll pull down the bullish to 308, 311s. All right, 308 to 311. And that'll update here in a second. All right, so here is a 302, 306. That's going to put a profit peak at 302. And it's going to put a profit peak at 308. And then we'll have 2 extra longs here as well that we can do stuff with. This right here is trading at about an even Steven. I mean, it's really close if you're to go 2 bullish and 1 bearish. And I'm not opposed to doing that. What that does is that creates a more neutral scenario because the first profit peak is actually below where the market is at. It's 302, 306. Okay. The best way to do this is through a watch list and just create it and then look at the different prices. But at 141, if I were to get in two of these at 70, that'd be 140 debit. And if I can get a 141 credit on the bearish, then that gives me a credit of 0 on these. It's not as good, but there's no risk to the downside, and I do create a scenario where I have a much higher probability of realizing a bigger profit at 302. Just to give you an example, okay? How far can you go down? We'll go down another 2 points, and we'll see. If we go down another 2 points, we're probably looking at a debit on this trade. And I'm just showing you how this stuff works so that you understand. So we'll go down 2 more points, 308, 306 on this one, and then 309 for the longs. And we'll wait for it to update here. So 171 credit versus a 108 debit. So you can see here that now we're going to be paying about 40 cents for this if we were to go down just 2 more points. And so you don't want to necessarily do that. I think the 171, this is you're not getting as much of a credit, and you're paying way more for the debit. Okay, you're talking about a debit of 210 versus a credit of 170 if you go 2 to 1 on this. Okay, so 302, that looked to be about the closest you could get, or the highest you could put this together and create almost a break-even trade, not quite, to the downside. Let's see, 311. Okay. So if I wanted to do this, I've got more risk in both scenarios. If I get filled on my credit, but then I don't get filled on my bullish, then and the market skyrockets, then how much am I risking? I'm risking $250 on this trade. Or if I get filled on my debits at let's say 144, and then I don't get filled on my credit, then I'm risking $144 to the downside. So I would do the same, a very similar thing in this, and that I would go with a 74, let's say 75, let's say 74, and then a credit of 145, and then a debit of 74. Okay, so 111, I'm just legging into each one in order to help improve my odds of not taking on a bigger risk while I'm waiting for all of the trades to get filled. Okay, so I'll save that one, and I have then I'll go ahead and put it in that one. There we go. All right, so we'll see. We'll obviously address all of these on Thursday. Thursday, the call is not going to be at 2 Eastern. It's going to be at 11 a.m. Eastern, because that is expiration day. That's the only reason I'm changing the time. I'm changing it because it is expiration day, and I want to make sure that everybody has a chance to know exactly how they're going to exit the trades depending on where we're at and what is going on in the market. Okay, so my first bullish was filled at 74 cents. And again, I made it to where I had a very high probability of getting filled on it on the first one. And then if the market moves up at all, then I should get filled on the bearish at 145. Okay. All right. Now, let me go back to the final piece on this, because it's very, very important. Everybody needs to keep in mind the context, because I see this happening over and over again, especially with newbies, in that you're trying to do too much with the trades. You try and force more than you need to force. You take more risk than you need to take. You see the opportunities that are presented. For example, like today's opportunities, and you're like, there's no way I can lose money, and so I'm just going to go all in. I'm going to risk my entire account on today's trades. But you have a problem in that if you make a mistake, you're going to, I mean, you could be in serious trouble, right? So you need to make sure that you understand this. And we're not trying to make a killing. A lot of traders see these types of trades, and it doesn't matter what I say, they try and make a killing with them. And there are weird instances where you might see a little bit of risk where there wasn't risk evident, especially if you make a mistake, or if you can't get out of one trade, or if you get in half of one trade and not the other, et cetera, right? So you want to start small, because the ability to compound, once you begin to increase your account size, you can compound. And if you get to where you can average $100 a week, you're talking about astronomical growth. In 6 months, you're looking at $30,000 in profit potential. You increase that to 5 years. If you're able to average $100 after 5 years, you're talking about well over $3 million after compounding. And it's just simple math. This isn't pie in the sky stuff. This is simple math. And never before have these trades been available the way they're available today. So this is a unique opportunity. And you definitely want to take it slow. Now, if you have not done this yet, you need to upgrade your subscription. If you are not a 1-year subscriber, you need to upgrade your subscription. Call Spring, 918-203-7547, and update. We have fast approaching in 1 month from this Friday, 4 weeks from this Friday, the July 31st to August 1st Triple Play Options 2-day online seminar, where I'm going to be going over all sorts of patterns, triple play option patterns, putting it in a methodical, easy to read format, explaining all of the patterns, explaining the different volatility levels. And I'm going to be talking a lot about the TPO profit stacking along with those as well. And so we'll talk about TPO patterns in high volatility, low volatility, and transitional volatility, as well as the profit stacking in low, high, and transitional volatility. And we're going to be talking about exiting. There's an entire session that covers exiting at the end, so make sure you understand that one. And then we'll also be talking about money management. And in fact, in the TPO session, I'm going to give you a way to where this is not the 5-year projection. If you can average $100, it's actually close to about 7 to 11 million. If you want to be a little bit more aggressive, not at the beginning, but as you get into this and you've proven yourself, I'll show you how to take a little bit more aggressive approach on the compounding. Not a lot, but a little bit, and actually increase that even more. And I'm being conservative when I say that. So you want to upgrade to a 1-year subscription to this, because the TPO seminar itself is $19.97. If you're not, if you're a monthly subscriber to my TPO Live Trade session, you're going to pay $997 for the seminar. But if you're 1 year, you only pay $297 for the entire seminar, and it's well worth $10,000 easily, by the amount of information that is in it and what you'll be able to do with that information over the course of the next year or two. And the rest of your life, for that matter. It's absolutely phenomenal, as you already know. So this discount ends after July 4th. So I'm going to give you through the July 4th weekend, and then this thing goes to the normal price, $29.97 for the seminar. You'll pay $19.97 if you're a monthly TPO subscriber, and you'll actually pay $9.97 for the 1-year subscriber if you wait until after the July 4th weekend. And the reason I have to do that is because seats are limited. It is live. Yes, you'll have lifetime access to the recordings, but it is live and the seats are limited. Okay. All right. I will stop there and have questions. All right. So I have 5 trades on from last week, all risk free. I looked at the combined trades and noticed I had a credit of $1. Therefore, I decided to put on a bearish trade that would only slightly affect the gain, counter some risk past 325. Let's see. I should always look to combine the bull and bear. I had so much bull existing. So yeah, I generally almost always look to combine a bull and a bear. That's what this is all about, is combining 2 synergistic trades as often as we're able to. As you are well aware, there will be times where I don't get filled on one. I'm filled on one and then I'm not filled on the other. And so you have to be willing to take the risk of whatever it is that you do get filled on, but I'm always trying to combine the 2 in some way, shape, fashion, or form. Sometimes it's even just with one order. But what you have to make sure, so Ryan, you say you have 5 trades on. You have to make sure that your dead zone on those 5 trades is not lagging, because that means that you have several longs, and you have to give $50 in the dead zone per long. That's how much room you have to give it at a minimum. So just make sure that you're not putting yourself at significant risk in that dead zone. Let's see, with SPY going up quite a bit today, why did my trades so increased? Loss over Friday's close when the trade is supposed to benefit from SPY moving up. Mark, you can't judge this based on, well, first of all, I don't know what you put on Friday. Second of all, you can't base this on today's movement. You have to base it on closer to expiration. What type of trade is this called in TOS? A diagonal straddle? I don't remember reading about the types. That's because you're not. These are diagonal trades, but it's a combination of a bullish and a bearish diagonal. You're not going to see this anywhere else. So good luck. On the $3 risk trade, I bought the 324 back at 02. What are my options now? Wait. That's your option now. Wait for the market to move up. Otherwise, you're not going to have any options. The trades that we're in, the market moved down substantially. Let's see, 302. Now we're moving down even further, so I may not even get filled today on this bearish. But yeah, I mean, there's no profit potential at this point, from this point down on Thursday's trades. Obviously, we're not going to lose money, but if the market moves up, then that's where we have some options available on either just getting out at a profit or enhancing our profits. Let's see here. Yes, this. Perfect, you bet. Will I exit anything on Wednesday? Ryan, I may consider exiting one of these bullish trades at a significant profit on Wednesday. So let me see here. Let me throw this up here. So the bullish trade, if the market moves up to, I would say 150. If I'm making $150 on one of the bullish trades, I may consider exiting one of the bullish trades. So at a spread of $2, I'd be making about $150 on one of those trades, on both of those trades actually. To find these 2 trades in PDS Trader, find there was a bearish trade. Okay, so PDS Trader. Let me let me see if I can pull up my PDS trader that I was using. Let's see here. All right. What I'll do is I'll just open another one and bring it back in here. Okay. So let's see here. 1 second. Um, 911. Where in the world did it go? There it is. All right. Let this load, and then I will pull it over here on this screen. 1 second. So we will have up-to-date information. And where in the world did my Zoom? There it goes. All right, so I'm going to go screen 5, and there we go. All right, so 7/2 is the expiration. I'm going to sort this by credit just so I know what I'm looking at. Obviously, we're not going to be looking at any of these trades that are currently providing a 7-cent credit on the super bullish, just simply because that 7-cent credit comes with a huge risk to the downside if that's what we were to do. So it's updating, and then we'll scroll down here. All right, so this is, again, the super bullish, 911 super bullish. I should probably just name all of these as TPO, which I will be doing before the seminar. All right. So here is an example of some bullish trades. There's no risk to the downside. There is a bit of a dead zone there. Here's one that's a 30-cent debit, but you'll notice that the 319, hopefully you can see that. The 319, which is the second call, is only trading for 7 cents. That's why I nixed this out of my equation. I just don't even worry about selling a 319. And that's because if the market actually moves up into this dead zone, then I'm going to be able to sell that 319 for a lot more than 7 cents, right? So that's one reason for doing that. So this is how, so what I do is I generally look for the bullish first and see how cheap they are, and then I look for a more simple bearish. And if I can get a more simple bearish, I will. If I need to be a little bit more complex with the bearish, then I will do that. Session 2 in the TPO seminar actually discusses in depth all kinds of bearish, including bearish trades that are that can make a lot more money. So big bearish trades that will make money if the market moves down. Significant amount of money if the market moves down. Okay, so I go through the entire range of credits. I should probably label it credit trades, which means that there's no risk to the downside. Okay, so we can go through here and we can take a look. Some of these, really small debit, the profit potential, the profit peak starts at 310. So like on this one, this is an equidistant spread, meaning that the strike difference is at 0, basically. And if the strike difference is at 0 on these trades, then the risk to the downside is going to be the debit, and the risk to the upside is going to be the debit. It's going to be the same, and the profit potential is going to be obviously at the short strikes. Those will be the two profit peaks. Okay, so that is similar to this one. But again, at 316, we're able. It's only selling for 15 cents. I can actually put on this trade, which is 310, 313 for about a 50-cent debit, and that's going to skyrocket my profit potential sooner as opposed to later. So I have big profits at 310 because that's where the short strike is. Okay. So that seems like it's a long way away, but in today's market action, it's not at all. And today's the 29th, tomorrow's the 30th, tomorrow's the last day of the year. If tomorrow is down, I'm going to be looking for a lot of. I don't know that you'll still be able to get them with only 2 days left. But if tomorrow is down towards the end of the day, I'm going to be adding to these trades if at all possible. All right, so because July 1st is on a Wednesday, that is one of the most bullish seasonals out there, and if the last day of June is down, it's extremely bullish. Okay, doesn't mean it has to move up on Wednesday, but that's the probability, and so I will prepare myself for that. Okay, so here's a 309, 312, 316 for 47-cent debit, just to show you. This is how I find them on PDS Trader. I really don't like this dead zone, but it's at $200 and it's only 2 longs, right? So I would actually be almost willing to pay 65 cents for this, or 60, yeah, about 65 cents for this by not selling the 316 to begin with, and then at some point selling the 316 at a higher price, or maybe even a 317 or 318. Okay, that's how I find these. Can I show the orders for the trade copy 2, copy 2? Let me find those. Let's see here. I want to move that one. And I believe this is it. Here it is. So I'm going to share that. All right, so market is still down a bit, but it's starting to come back up from where it was. So I was filled on the bullish, and this is the risk that you take when you get into these. The only other ways to do it at market, and the other day when I did it at market, we were filled at a debit of 8, as opposed to a credit of 3. So just to show you that you don't want to do this at market. All right, so there is that. And right now at 67 and 135, it's basically the same price, right? So you can still get it if somehow you can get this, based on where they are right now, it's very, very close to being no cost. Clean firm is not licensed broker dealer in Australia. So Philip, I would not be paying. I would check with IB before I go with Schwab at 65 cents per leg. No, that is not standard rate. And TD Ameritrade is also no commissions, but I think it's 65 cents per trade. I don't think that's per leg, but I could be wrong on that. I have clients who opened with in Australia that opened with Tradeer, so I need to circle back with them again. Let's see. Recording all is there a discount for the 1 year 2? Steve, yeah, give Spring a call. And her number, just to put it back up here for you guys. Where is it? There it is. 918-203-7547. When I turned on SmartFlow and my trade started, I then decided to turn the system off. I checked Tradeer and my first unfilled order stayed live open. All right, so when you Tim, when you turn a system off, it does not cancel the orders that were already placed. You have to go in and cancel those to begin with. You have to go in and cancel those manually. All right, does the early bird special include annual subscription? No. The early bird special only includes 3 months of live trade sessions. That's why I say buy the early bird or buy the year subscription and then buy $297 of the early based on the 1 year subscriber. Could you show us a simple 4-legged one order TPO to put on today? Tim, actually no, because there aren't any that I'd be willing to take. We're too close to expiration. I got filled on only the first half of the trade from last Thursday, 317, 319, 21. Should I just take the risk? It doesn't look as though adding longs. Yes. Charles, if you're only filled on the bullish side, you have to be willing to take the risk of that. Otherwise, you need to go in there and manipulate the price, not manipulate the order, so that you make sure that you're filled on a bearish. If you absolutely have to get filled, that's the only way to do it, to make sure that you do get filled on both sides. What times will the TPO seminar be conducted on July? It's all day, Ron, both days. Can you review the outline of the exit methodology, exit on a limit sequence of taking off legs? That's why we're, so we'll go over the exits on Thursday, Robert, Thursday morning. Okay. The reason I asked about TOS is because I'm trying to execute trades. However, with TOS, you need margin for certain types of option trades. The margin shouldn't be for any more than the risk on the trade, Ron. Yeah, you have to have a margin account, absolutely. And you have to be cleared on, I forget what the level is on options. When a bullish trade spread reaches a peak profit zone, even in the early in the week, is it the very best to close the bullish trade in most cases? Aaron, no. The answer to that is no. The question being, when a bullish trade spread reaches a peak profit zone, even if it's early in the week. All right, so what he's saying is, let's move this down here. What he's asking is, okay, this particular example, this is not the bullish that we have on, but it's a bullish trade. If we move into this profit zone here early in the week, should we go ahead and take profits? And the answer is no, that's not an absolute. You have to take a look at the minimum profit potential. And if the profit in the profit zone, because it's too early in the week and we haven't really seen the trade mature yet, if the profit in the profit zone is only at about what the minimum profit is on that bullish trade, or maybe even just slightly above, there's no sense in taking it at that point, because if the market continues moving higher, you're going to make just as much money. And so the whole reason for taking that off early is to further reduce any risk to the upside or to substantially open up the profit potential to the downside. And so that's what I look for. When will I put available TPO session 2? I don't know, because I want to finish the entire thing before I upload session 2. Yes, I will make a few of these available early. I just don't know how much early. So for you early bird guys, you will have early access to a few of these, but not all of them. And it's not going to be like this week by any long shot of the imagination. How can we define a dangerous dead zone? It's the way you define a dangerous dead zone, Ryan, is by looking at the absolute peak lag, right, of the dead zone, which is what you see here, and that's at 312. And you multiply the number of longs by 50, and you subtract that from where the profit is. And so on this one, the number of longs is 2. And so 2 times 50, that's $100. I'm going to assume that if I hold on to this until the absolute last minute, which is another way to address the dead zone, is not to hold on to it until the absolute last minute. But if I hold on to it until the absolute last minute, then I have a dead zone here that probably going to go to about $100, maybe even a little bit more. Okay. If I have this dead zone here that lags at $200, but I have 10 longs, you're going to get crushed in that dead zone. Even though it shows a $200 profit potential, it's only it required 10 longs to make up that dead zone. You multiply 10 longs by 50, that's $500. You can expect this to drop below by as much, or excuse me, yeah, $500. You can expect to drop that to drop to as low as negative 300 if they crush the volatility. That's the most common mistake traders make, is they build up this huge trade and they're like, oh yeah, my dead zone's at $200, but they have 30 longs that make up that dead zone. Listen, a 10 point difference, 10 cent difference in the projection versus the actual with 30 longs is $300. These projections are not 100%, and we already know that the volatility is going to come out. So that's how you determine that. Be very, very careful about those. And it's not necessarily about how far the shorts are apart. There is some of that. I'm less concerned about this type of dead zone because the second profit peak is above the first profit peak. And when that happens, you have less risk. It's not absolute, but as a general rule, there's less risk of that dead zone being that much worse. What is an example of a trade I would take if the market is down tomorrow? I would look to take very similar trades to what I got today, depending on whether I can get the prices or not. If I can't get the prices, I would have to, I'd go through the same process. I'd open up PDS Trader, look at all the bullish trades, and then choose one and find a bearish trade to pay for it. Let's see, would be great if you could spend more time on four-legged TPO trades. We can put on one order if possible. Thanks. Okay, Tim, I'll consider that for the future. Four-legged trade sat unfilled. That's the market at one point. Eventually, it was rejected by the market maker. Scott, I would have to see. I can't really make comment on that because I'd have to see the trade. Nuno, no, Spring's email did change. So I will get that to you. Option prices at TD Ameritrade 65 cents per contract. So, oh my goodness, it is, Steve. At TD Ameritrade, option price are 65 cents per contract. That is a ripoff. $1.30 for two-legged options. That's a ripoff. So is that per? So if I do a 2-1, is that $1.95? If I do two legs that are 2-1, is that $1.95 at TD Ameritrade? I don't trade through TD Ameritrade. Some of my support staff trades through TD Ameritrade. They would be better able to answer that. I don't like TD Ameritrade. I don't like IB. And I definitely don't like Schwab. All right. Thursday's call, 11 a.m. Eastern. Thursday's call is 11 a.m. Eastern. If I do the bull side First, will trader recognize the bullish as reducing the bearish trade's risk and lower the margin required versus the whole margin of the bearish? Mark, they honestly, they have been inconsistent about that. And the short answer is yes, but not 100%. And the reason is because they are on separately, right? So, PDS. Yep, okay, got that one. Can you show us how to change or adjust the second order when using SmartFlow? That's a great question. So let me pull this one over. All right, here. All right, this is a smaller account that I take all of my live trades in. So we're trading at $1.42. If you recall, I got filled on the 74-cent SPY 74-cent debit, but I was not filled on the bearish trade. I would just go in here and I would say cancel and replace order. Whoops. I would have to turn off the smart order first. And the reason I would have to do that, so if this were the last order, I could do that. If it's not the last order in the sequence, then I have to go and turn it off to manipulate it, and I don't want to do that because this is the one where I have a bullish of 74 cents and then a bearish of 145 and then a bullish of 74 cents again. And I am on the verge of getting filled on that 145-cent bearish credit trade. All right. If your max risk loss on the downside is $5 using two spreads, a bullish and bearish spread, do you have to wait until expiration at 4 p.m. for full profit and max loss on both spreads? Well, there's no reason to get out. If you're suffering most of the loss, there's no reason to get out because at that point, if the market moves back up, then you'll have some profit. So, and when I say max loss, if you're at the minimum profit, let's put it that way. So you're at a credit or you're at a no cost, and I was just filled on the 145 put spread, not put spread, credit spread. I was just filled on the 145 and again filled on the 74. So I just got filled on all of these. The 302, 306, 308, 311, and then the 330, not that one. The 308, 311, I did twice. So I did one bullish, one bearish, and then one bullish again at the same price. And it's for a small debit, a 3-cent debit. So there's my $3 risk on this particular trade. But my profit potential, I have a profit peak at 302. And I'm going to go ahead and tell you that if I wanted to, I can go ahead and sell. I can create a credit if I want to by selling a 314 or 315 call option on this trade on one of the bullish because I have 1 to 2, right? I could do that if I wanted to, and I'd create a credit. What are those going for? Those are going for. Well, let me. Whoops. Why does it keep doing that? All right. So 629, 7. Oh. So we'll do this. The 315s are going for 20 cents. Okay, I could sell a 315 for 20 cents. And now I have a 20-cent credit on this thing or 17-cent credit on this thing. I still have a massive profit potential to the upside. And I actually create a profit peak at 316 or 315. Okay. And at 315, that's 4 points away, by the way. All right, let me see here. Wow, three-legged, that is nuts. 65 cents an option leg per. That is nuts. With these four-legged trades, why not enter them in one order instead of two? Oh, yes. So you have a much lower probability of getting filled at the same price. So it so happens that I have these as these are four-legged orders. I see what you're saying now. I apologize. I'm a little slow sometimes. So let me do something here for you guys. And I know we're going into these things are becoming really long, but um, you guys are worth it. So, all right, I'm going to do a place trade, and I'm going to say 302. No, you know what? I'm going to do 304 and 307. I'll pull this over here in just a second so you guys can see what I'm doing. As soon as I get this squared away, 7276 and a 308. 308. All right. I'm going to pull this over. Here we are. 304, 308, trading at a credit of 316. Then I'm going to go with a, let me see what I'm going to go with. See, I can't even get 310, 310, 313. So then I'm going to go, let's see here, 310. And 313. I'll just change it up here. So that's a 13. And I'm going to go 4 and 2. Whoops. All right. Is that really showing at a 26-cent credit? Did I do that right? 310, 308. Let me make sure. Market's trading at 303, 307, so 302, 306. And 302, 306. Yep, I did that right. All right, so that's showing at a credit, 25-cent credit. So let's try and get this bad boy filled, shall we? Credit. So it's trading. See this bid ask, 33 cent versus 20 cents. That's the problem with these types of trades. You've got three different trade sizes. You've got four legs. You've got four strike differences and two different expirations. So I'm going to do a credit, and I'm going to go 22 cents. Whoops. 0.22 credit, and then I'm going to place the trade, and that is not the account that is in. So let's see here. All right, so that is and you can see all these leftover long calls that were worthless that I just held on to from last week. Anyway, so this is at a 22-cent credit. To get filled on one order, let's go down by 2. And by the way, you can do this using smart fills if you wanted to, up to a certain point. And let's see here, that's not it. All right, so now we're at 20-cent credit, and it's still not getting filled. And I guarantee I get filled on those at a 20-cent credit if I were to leg into them. So that's the problem with that. Okay. What's the last day I would take a trade? Probably Tuesday of this week, Wednesday of other weeks. Mark, you can always watch the recording later. All right, looks like I got all the questions, and we'll see if I'm ever filled on this 20-cent credit. I'll leave it in place, and we'll just go from there. All right, everyone, have a wonderful day. I will see you guys on Thursday morning.